Hey, Mark, how you doing, man?
Good, Matt. How are you?
Another great day.
Nice. Welcome to Your Time, Your Money, the show where your time is just as valuable as your money, and we know that. We always want to bring education to our listeners, to our clients, and to prospects as well. Today we have an exciting day. This is our very first time on the show where we have a guest speaker. We figured it was a very timely time to bring in a CPA, and we brought David STACKROW in from Scott & STACKROW in Troy, New York. So I wanted to give a little introduction to David. We'll get into some topics relating to retirement, tax planning, and what have you. So welcome, David. Good to see you.
Thank you, Mark. I'm grateful for being here and for being your first guest.
Awesome. So
First one, just don't mess up. Let's go. We got it.
Yeah, no pressure on there. So I got a little bio for David. He doesn't know that I pulled it off his website, so hopefully it's accurate, which is a good thing, which I'm sure it is. But he started with Scott STACKROW actually as a staff accountant in 1986. And actually rose up to managing partner. Been responsible for general oversight, operations, quality control, accounting, auditing services, strategic planning, a ton of other things that they do over there from helping out with estate planning, I know, and individual taxes, business taxes, corporate taxes as well. He's a member of the American Institute of CPAs and New York State Society of CPAs. And on a side note, he lives in Postonkill, which is only a few miles from my house, which is
You guys love living out in the middle of nowhere. Like,
Well, we sure
what's
do.
going on out there, man?
nothing beats Rensselaer County.
They giving out like free hamburgers or something when you move out there?
Oh man, I don't know. I was in Waterville Elite, so Gus's hot dogs was hard to
I love
compete
going to
with for a
Gus's
while.
once in a while. I'll make a stop.
So, one of the main things that, we always like to tell clients is, when you're working with a financial professional, that professional is only as good as the other people that they can refer on to or network with.
Oh, yeah.
And, that three-headed monster we always talk about of a financial professional, an accountant, and an attorney can do so many things for a client that just an individual advisor can't accomplish.
I mean, I feel like there's got to be a balance, right? And I'm guessing you've seen this before, David, where if someone has a CPA and their financial person is the same person, I'm guessing that it causes some issues, But I want to get to the meat of it, and I want to make sure David gets a chance to talk to our listeners. So I think we're kind of ready to flip this switch and make it happen.
You are. Your time.
Your money. Let's make it happen.
Go ahead. You do it.
All right.
Try not to break it this time.
I'm not trying to snap it. My muscles are so big. I'm working out so much. So yeah, I mean, jump right in. Let's talk what's important right now.
Yeah, I think one of the first things that we really want listeners to hear about is some of the major changes that came through with the Secure Act. And as with anything, I remember when I was first investing when they didn't have a Roth IRA, it took years and years for people to realize what a Roth was. Mm-hmm. And I think that's kind of the unfortunate thing is a lot of the tax law changes just take so long to let people know.
And they do. And unfortunately, some of the tax law changes are happening frequently, too. So what happened last year may not be the same in 2025 when some of this stuff sunsets. So it's hard for people to keep on top of all that. You mentioned the Secure Act and the changes with RMD. That pushed the age out to 72 for people that need to take an RMD. But it's still April 1 following the year you turn 72. So it's not even as simple as just the year you turn 72. Most people want to take that first distribution the year they turn 72 only because if they wait until April 1, they have to double up. And that may change the tax bracket that they're otherwise in. So, but
how often do you see that? How often does that happen where someone doesn't have a great advisor or they don't have a communication set up and then they're getting double hit? Does that happen a lot?
It does happen because, we run into clients who, when they get to that age, they've spent their whole lifetime saving.
Right.
And there's an emotional, it's emotional for them to change the switch to start to draw out of those accounts. So people have a tendency to want to put that off as long as they can. I mean, we have clients, I'm sure you do, who would prefer not to take anything out of their retirement accounts. They want to just let them ride because they may not need the money.
Yeah.
So it does get missed, and to be honest, just as part of the tax changes last year, for 2020, people didn't have to take an RMD. That was part of the COVID relief. And we're seeing this year that some people forgot to restart that. So they might have been in the process of, just being in the cycle of automatic distributions. And in some cases, those didn't restart. So we're finding, I've had a half dozen people so far this year that did not take their RMD, and we're trying to fix that for them now.
You got to back it out. It becomes a bigger problem, I'm guessing.
Well, and for the person not working with a CPA, that could be a big penalty.
It could be. It's a 50% penalty if the IRS were to impose it. I will say that in every instance where I've had one of these situations that somebody didn't take an RMD, there's a form that you can fill out and submit with your tax return and ask for a waiver from the penalty.
Sure.
The IRS really wants to see that you fix the mistake. I've never seen a situation where they've come back and actually imposed the penalty if it was a simple oversight or somebody just missed.
Like
maybe they missed an account.
An oops moment, right? Yeah.
Exactly.
So I mean, like as you're talking about RMDs, and I feel like this is a natural question to ask. I mean, for the amount of work that we've done with clients, and Mark really instructed me on this and helped me understand it, the Roth conversion process and making sure clients don't have to even do an RMD. How often in your practice do you see clients that work with an efficient advisor that talks about Roth conversion from age 62 to 72? How frequent does that happen? Because I know it's a big part of our practice.
Well, and for us too, we find it's not very common that it's been
not.
presented to the higher net worth client.
And I feel like it's a big miss. I just want to hear that from someone that sees it every day. How often do you see that, and how often should you see that, I guess, are the two questions.
Well, and you're absolutely right, and it is a big miss. And it's another one of those situations where clients don't feel that they need the money, so that presents the perfect opportunity for that Roth conversion. So we end up with clients who maybe they retire, maybe they're on a pension or they don't need to take their retirement money. Or just a situation where their income drops because they retire and they spend down savings.
Right.
So all of a sudden what used to be taxable income lowers them into a tax bracket where they may be paying very little or no tax. Perfect opportunity to actually do those conversions. They may not need the money, and nobody wants to pay tax, but there are some times when it makes sense to pay tax in order for the greater gain down the road of having the ability to create an asset from what was taxable into something tax-free. And again, I mean, the beauty of being able to pass that on to your heirs if you don't need the money.
Yeah, it's huge.
It is huge.
Well, it's a good conversation to have because somebody's going to pay the tax. And would you rather have somebody in a lower tax bracket pay it than somebody that's going to inherit it in a higher tax bracket?
Right. Well, I mean,
based on age or...
Let's do a real world. I love doing real world scenarios. I mean, let's say there's a spouse that they lost their significant other, and now they have a $2 million traditional IRA, and they're 75, so they're taking an RMD. Now, if they pass away, and I'm guessing you've seen this before, and they have two children, well, both children get what? They get the inheritance, and the inheritance has to go into a
rollover IRA.
A rollover Benny IRA. And then what are those rules? What do those rules look like?
Because they've changed a little bit.
Because they've changed. So I want to make sure I understand it because I know we're always on the cutting edge on giving good information.
Yeah, so again, with the Secure Act, the rule changed and it became, in a sense, more punitive. So my dad passed away in 2010. So his IRA was under the old rules, and my brother and I split his IRA. We each got 50%. I'm able to take distributions from his IRA over my lifetime.
Got it.
So my brother, a little bit younger than me, his distribution is a little bit less because his life expectancy is longer. With the Secure Act, that required cash out from those inherited non-spouse IRAs is now 10 years. So you can wait until year 10 to take it all out. But even if you take 10% of that large asset that you just mentioned, it's a significant amount of income. Often that children, the survivors, are taking at a time when they may be in the prime earning years of their own careers and already in a fairly high tax bracket.
Well, your situation is a perfect example. In 2010, in today's rules, you would have had to start taking it all out by 2020.
Correct.
While you're still working, and not sure what ages your children were at that same time, whether they were applying for financial aid, and that was maybe income that you would have had to declare on the parent forms for assistance. That can have a snowball effect on really.
Oh, and I mean, like so if that person's kids get that $1 or $2 million or $1 million each, now they have to take out a minimum of $100,000 a year. Yes. Not even considering growth.
Yes.
And that's going to do what to their income? That's going to jump it up by $100,000. But remember, it's important. I think, David, where we started the question was, how many advisors do you see telling their clients do a Roth conversion? Because if we attack those pre-tax dollars over a period of time, then by the time you get to 72, guess what? the seesaw is
Yes.
the other way,
Yeah.
right?
So to answer your question straight up, not many.
Okay.
It's one of those areas that there's definitely a need for more education. And I think in some cases it's just, the client doesn't know because nobody's telling them. In our case, we may not know because we don't know that they have the asset.
Right.
We don't see that stuff because it doesn't show up on a tax return until a client starts to take
The money.
distributions.
Well, I mean, we started this with like asking, how many times do you see a CPA that's also the advisor, or does the financial plan of a portion of the plan? And what is your experience with that? I'm sorry, I don't mean to sidebar, but it's important. I think clients and prospects know how frequent should that happen, David, where the CPA is the advisor, or should they be a separation of church and state, right, where they work together? So
I'm a firm believer in the concept of working together. To what Mark commented on earlier, I think the team approach of having a good attorney, a good estate attorney to help with the planning, a good financial advisor to help with the investing, the insurances, long-term care, all of those kinds of things, and then a tax advisor to help on the tax aspects. We do a little bit of financial advising. We don't sell any product.
Right.
But our clients are comfortable talking to us in part because they know we aren't selling a product. So there's nothing for me that's biased in any way.
Right.
But we're always going to send them to somebody like your firm where they can get what you advise in is your specialty. I mean, my specialty is not, financial advice. I can look at a tax return and see that, maybe somebody has, though not much in this day and age with interest rates where they are, but maybe they have too much taxable interest income, and it would make sense to invest in some tax-free bonds.
Got it. Like
I don't
bonds or
sell
something.
tax-free bonds,
Right.
so I end up working with firms like yours, to send them your direction in order to make sure they're getting the right advice from what you do best.
Well, that's similar from the estate planning attorney. I don't know how many times I've run into prospects where I went in their household and I talked to them about an irrevocable trust, and they have one set up. And then the next question I ask is, was it ever funded?
What's in it?
and there's nothing in it because the attorney did the job but didn't tell them, hey, you need to
Take
move
the next
assets
step.
into the trust. And in some cases, people have had it the 5 years for the look back. And it's like,
Nothing's in it.
what? I never knew that nothing got moved into the trust. And we laugh, but it happens more.
It happens.
Yeah,
Oh, it
happens
does.
more
It
often
I
than
does.
you would
mean,
think.
we have a whole show dedicated to just trust planning and estate planning. So I think it's important that we kind of segue into that at some point. But
And I do think that becomes part of the trust. So it's really where the team, when all three of us are talking the same language, it's not just me telling a client they need an irrevocable trust or the attorney saying that. It's all of us working together about, explaining what the benefits are to the client of having that.
right.
Sometimes it's not about, having all of your assets in an irrevocable trust. If you ever need long-term care, you've given away your options of where you might want to be placed. And I know you said that may be a conversation for another day, but it is really important about that whole team approach because it's not my area of expertise. I can kind of comment from some of the mistakes or failures or
Seen happen on the other side.
Yeah, exactly.
Right. Well, I mean, I feel like Mark, this is the teaching part where I'm always willing to learn something. I think our practice does something very important is if we don't know something, we say, hey, we don't know, but go talk to the person who does. And I feel like that communication is so important for everyone to know. If someone's telling you, hey, let me just try to figure it all out, you got to step back and say, wait a minute, why aren't multiple people looking at this at the same time?
Well, and the difference in our practice, too, is when we refer people on to other professionals, we follow up with the person and make sure they called.
Right.
To make
Did you
sure
do it?
they set the appointment. To make, because a lot of times you get referred on or you refer somebody on to an attorney and they just take the information, they go back home, and they never call them. And
Right.
then you meet with them the following year. And, did you get that planning done? I never really called
I
them.
have the packet still. It's sitting,
You know what I mean?
sitting on
So,
the pile.
after 22 years, you learn procrastination is the worst word in the world. And, I think that's where we set ourselves aside is by going back to that person within a 2, 3, 4 week period saying, hey, I gave you this information. Did you reach out? If not, let me reach out, schedule the appointment for you, or go on the appointment with them, whether it's to see a CPA or an attorney in their
Right.
office. And sometimes we're that middleman between explaining what they're trying to do with the finance and, and kind of driving the conversation.
We keep coming back here, right? The magic 4-letter F word, fear, right? We're fearful and we don't have comfort with going and meeting someone new because I don't know who they are. Are they gonna try to overcharge me? Who is this person, right? And this has been a common like underlying factor with whatever it is, investing or the market. Fear plays a major role in whether someone can complete a task or not. So
we're not changing the name of the show to Your Fear, Your Money.
Your fear, your money. Be scared of the bear
Although I
over
think
there in the
every time
corner.
we bring up. So I'd be interesting to hear, because you get a lot of hedges from a client sometimes working with a CPA saying like I just go to H&R Block or I just go to a tax filing service and
TurboTax.
and I always tell them you're doing yourself a disservice because you want that extra set of eyes and knowledge behind what you're doing. What are maybe some of the common mistakes that you see in tax returns? Somebody gets in trouble or they haven't filed or traditionally they've used the tax service, but they come into you later because there's errors, and maybe they didn't even know there was errors, but maybe you find them.
Well, and we do. So, just part of our process, when we take on a new client, we usually ask for their 2 years of prior returns, just so that for two reasons. One, to look to see if there's anything that maybe we should be aware of and ask for, but also to look to see if there's anything that was done in error. I can't really comment on the H&R Block or the Jackson Hewitts. They do good work. It's just different work than what CPA firms do. I find that people who use TurboTax on their own or Tax Act, they tend to be ones that may do something, again, not intentional, but they'll run into an issue where the software asks them a question and you can interpret an answer to a question different ways.
Yeah.
And unfortunately, those are the situations where we see that people may get into trouble, where they think they're comfortable.
Right, I put it in the traditional box instead of the Roth box.
Right.
The data entry,
Yep.
they didn't understand the concept of the question. And
Well, to kind of go one further on what you said, Mark, like when people come in to meet with you, like what are some of the things that you see go wrong? Are they not prepared or they don't have things itemized? Like what would be some of like a hint or something important for a new client that's going to go CPA do correctly?
So I would say one of the things that's pretty common is people who have a rental property where it's really a vacation property. It may be part used for rental and part used for personal. Again, that's a situation where we have to ask how many days did you use it for personally and how many days did you rent it. And depending on the ratio of those days determines what's deductible. In a lot of cases, if you're using it more for personal use than you are for rental, then you're limited in your deductions to whatever rent you collect.
Got it.
And again, some through that TurboTax, and I'm not faulting the software, I'm not negative on the software, but whether you use any one of those home products where you're doing your own tax return, you could answer the question thinking you're answering it correctly. It's a rental property.
And then you get audited.
Correct.
So I'm guessing VRBO has been a major thing for you guys because everyone's doing it.
Correct.
Right? Everyone's doing VRBO. I mean, if you're listening right now and you're saying, yeah, I do a VRBO, what are some of the pitfalls there? I mean, I know we're a little bit off topic, but I think it's important for people to know. Like, if I do a VRBO and I have 2 or 3 properties, what are some of my pitfalls? What should I worry about?
Well, I think you need to make sure you track your expenses. Make sure you have documentation to support the things you're deducting. If it's if it's your residence, I have clients who rent out part of their residence, so they may have a couple of bedrooms and a bathroom upstairs on the second floor of their house that used to be their kids' rooms, and now they rent them out to people that are coming in from out of town, and so there it becomes an allocation.
Sure.
So those are the things to be careful of. It's not that it's difficult or it's not really complicated. It's just a matter of understanding the rules and making sure that you're reporting things correctly.
Cool.
Yeah, and same thing with small business owners. A lot of times small business owners are so aggressive in their write-offs that they don't realize that by not showing the income, they're also affecting their Social Security down the road.
Oh, yeah.
That's a big problem with a lot of independent contractors and business owners for the first how many years of their
Right. They're
their
trying to get away with the tax side, but then they forget, right?
Yep, and maybe they don't have the additional assets to start retirement accounts in addition to that. So not only are they not saving on the retirement side, but they're shooting themselves in the foot for one of the largest vehicles that most people have in retirement, being Social Security.
Social Security.
Yeah, and I think, honestly, we saw a lot of that through COVID. You look at some industries that are cash-based and people work under the table,
Right.
and they think that's great because they're getting, income that they may not report. But then all of a sudden, when they were out of a job, there was also no unemployment because there was no income that they could show to collect a benefit. Or, you should mention those small businesses, Mark, where they may want to keep their income down or even have a loss. Small business owners, which are traditionally not eligible for unemployment benefits, became eligible, but again, based on income.
Based on
So
what
if you
they've
had
shown.
no income to show,
That's huge.
your benefit was based on that. And you may have gotten the extra that was available through the COVID relief packages, but you weren't getting the base benefit.
Yeah.
So.
Well, the good part about this conversation is that it's going to continue. But right now we're
halfway
at an exciting
through.
part of our show, and that's our community spotlight time.
Best time of the day right here. Community
Always,
Spotlight.
always a great time. This is a focus of us on a local business that we just want to make clients aware of and the job that they do over there. Today we're going to highlight Advantage Tree Service over in the Bethlehem area.
Fantastic.
Glenmont. Matthias Kaib is the owner over there. Really all around, classical tree removal service, but with the extra touch of making sure that everything is done right. They don't leave ruts. I don't know whether you've had trees removed before, but
14 mark at this point.
I mean,
14.
if the soil's soft and you got some of these multi-ton trucks going in there, they leave ruts. They clean up. The branches are still there. They clean everything up there. They do tree trimming. They do thinning. They'll do the stump grinding as well. A lot of money in equipment that they have over there. Logging. They'll do full land clearing. I know they on 9W. I have a friend down there that they helped out with 3 acres of land, just completely cleared the whole land for them. And they actually have a chipper. It can take up to 21-inch branches. So that's a pretty decent-sized chipper.
How many human beings can you fit in there, Mark?
One of you, Matt. One of you. So if you want to reach them, you can reach them at 518-944-5172. They're over on 772 Delaware Ave in Delmar, New York. Once again, Advantage Tree Service. So exciting to bring them to light for the clients.
They're fantastic. I'm sorry. I was like ribbon Mark. I'm sorry. I can't help myself. I gotta keep him on his toes. I do want to backtrack though for a second because we said TurboTax and we're talking about people doing it on their own. If let's say you work with somebody, what if they get audited? And then what's that process look like? Do you take over? Do you help? And kind of give a narrative. If you're doing it on your own to save some money, what does that look like when you're on your own? So I want you to kind of explain that.
So, one of the things that we do is we would immediately file a power of attorney with the IRS or New York State so that we could then represent the client on behalf of either one of those agencies. One of the advantages to being the intermediary is that everybody that goes through one of those processes gets nervous, right? And they may not be doing anything wrong, but may tend to say more than they should say just because they're trying to be good and conversational and generally less is better. So answer the question that you're asked and don't provide more information than what you're asked. We can do that because quite honestly, in some cases, we may not know the answer straight up. So we have to then go back to the client and get an answer. But the client isn't on the spot trying to come up with an answer that may make sense or maybe maybe they misspeak. Right? Maybe they just misspeak.
Yeah.
So, auditors are good people. They're doing their job. And honestly, there have been few instances that I've had clients who've gotten into any kind of trouble. Sometimes something will get flagged. And the flag, quite honestly, may not even be something in their return. It may just be an item that the IRS is focusing on. So, we've seen that with New York State. The sales tax audits will focus on a specific industry. Most recently, it seemed to be landscape contractors. So, we had 3 landscape contractors in the office who got flagged for a sales tax audit, but that was an industry. So they'll gather data, and they'll use the data that they gather from those audits to try to improve processes and figure out, what they need to do to help. The auditor in one of the cases said to me straight out, he said, your client's made a couple of mistakes, and that's not what we're here for. What we should be looking for are the clients that are competing with your client and not registered for sales tax and running out of a truck.
Right.
They're not licensed, they're not paying taxes, they're off the books. That's what we should be out looking for. So I don't think any of them are trying to do the gotcha thing.
Right.
But for clients, it is one of those things. They get an IRS letter or they get a New York State letter, and automatically it's a fear thing.
It's scary. I only ask because it happened to me once. I was playing football. I was in Jersey. I was in New York. I was in Texas. I was a resident of Texas, and New York sent me a letter to collect $40,000. Right? I was like, what is this? thank God I had somebody I work with at the time. I just gave him the letter. He goes, hey, sign this. A month later, I get a letter saying, nope, you're good. All set.
And that sign this was probably that power of attorney.
Power of attorney, right.
Yes.
That's what it was. When I was young, I was young and stupid. About 2008, I was still very wet behind the ears. Well, sign it. Sure, yeah, here you go. Fix it. But I think it was important for people to know.
Well, that can't be misstated either. Is just the amount of pressure that takes off a client. Like you said, that fear and just the calm person to go to say, hey, you know what? They specialize in this. They have us, and they're going to take care of us no matter what. And that's the benefit to working with a professional, right? If you're on your own and you're dealing with it on your own.
Oh,
I mean, that could quickly
I would
become
not want to have to deal with that. I was traveling, playing football, running around the country, and now I got to deal with this letter. Like, I'm glad that I had somebody in my corner. That's my primary reason for asking that.
Well, let's switch gears a little bit. Let's just talk about a little bit more, maybe some creative tax planning. One of the things that we find when we meet with clients and we try to explain to them, right? Taxes are progressive, and not everybody understands that word progressive, meaning that, I say, think of a bunch of buckets and you fill the first one up with a hose, and as it fills up, it flows to the next one, and then it flows to the next one. And people are always worried about going to the next bucket. A lot of times they don't know that, like, once you go to the next bucket, it's only those dollars being taxed in that bucket. They think it's
oh my God,
across the board.
all my money just got taxed at a higher rate.
But then the other thing we find a lot of times is they'll just every year always fill up the last bucket by a quarter of the way. And they're going to be in that bucket probably for the rest of their life until the RMDs get enough to push them maybe to the next bucket. Can you speak a little bit on that and just why it's important to try to maybe fill up that bucket in some of the planning?
Yeah, and I think, to one of the comments you made, Mark, people will often say, geez, I made more money and I paid more taxes. And that's not, in my mind, that's not a bad thing. Our tax system isn't so progressive that, you're paying more than you make, right? We're not paying more than 100% of what we make in taxes. So as bad as it is that we have partners in what we earn, and we share our wealth with those partners.
Uncle Sam, he wants your money.
We're still, you make a buck and you're going to keep 60 cents of it. So that's still not a bad deal. But you're absolutely right, and it goes back a little bit to my earlier comment that people retire, and I'll use retirement as an example, and all of a sudden their income may drop before they collect Social Security, before their RMD age, and they're happy spending down their savings because they don't want to take more income. So there's a period of time where they may be not filling up those lower tax brackets, and the tax brackets are 10, 12. It jumps to 22%, so there's a 10% bump there. But once you're in 22, it goes to 24.
You're there for a while.
So again, in some cases, it does make sense to take more income, even if you don't need to spend the money. You can always move it to another investment vehicle. And put it into something that's going to be tax efficient, but at least you've reduced your IRA or your retirement vehicles down. So your RMD, when you get to the point in time, maybe it's not going to have as big an impact on your taxes because you've sooner than you needed to taken some of the money out of that bucket.
It's manageable.
It's more manageable.
It's not this monster that we're dealing with, a $300,000 RMD. At 80 years old.
And because one of the things we try to do is, advisors are very good at showing future value of money for a 30-year-old or a 40-year-old getting to retirement. But then they stop showing that on the compounding as they get older.
Right.
It just magically disappears, and they don't show the 1 million going to 2 going to 4, and by the time the client's 86, say what that means in RMD.
Yep.
And when you tell a client like, hey, your money could be worth this, which is a little easier for them to picture it being worth that because they went from 0 up to $1 million or $2 million. It's much easier for them to see it going to $4 million because they've lived the first doubling of their money or tripling of their money.
Sure.
And when you can illustrate an RMD and say, hey, what, if left unchecked, your RMD is going to be $300,000, $400,000, which is going to push you to the next tax bracket. And then the other conversation we like to have is IRMA for Medicare.
Right, or Magic, right? Magic becomes a big problem too. Yeah, okay.
And that I don't know how many times I've walked into a prospect's home and just mentioned IRMA, and sometimes I get a look like, was that my old aunt?
Right.
Was that a hurricane at some point?
It's your income-related medical adjustment, and it has to do with your income. But a married couple, their healthcare costs could go through the roof later on in their 80s.
Because they're put into a different bucket as far as their income goes, and that affects their Medicare premiums.
Yeah, because they're handcuffed into the forced RMD, required minimum distribution, and that's where we see a lot of the ins for our group with other people that work with advisors is just these topics aren't being talked about, and I think it's a disservice because most clients will be okay.
I'm all set. We go back. Set. I'm all set, right?
That's a common.
I'm all set.
Reaction.
I got $1 million in my IRA. I'm good.
Yeah, but it's and most of them will be okay. They'll be fine. Like you said, they have a pension, they have Social Security,
right?
And they'll be fine, but not perfect. Yep. And when you show them, it's a difference of okay, you're going to pay $800,000 in taxes over your lifetime, or $2.3 million. There's a huge difference there.
I mean, how much money do you want to keep? How much money do you want to keep for yourself and for your family? I mean, you look at it like this, right? You saved your whole life and you've grown this asset pool and you don't want to spend it, which a lot of people are there, right? But you're okay giving it away to the government via taxes.
Yeah.
How is that okay? And again, that fear factor, that mindset of fear, it gets in people's way of making a decision or making a smart decision. So
yeah, and I think all we can do is give people the information. It's unfortunately the people that are uninformed and go in and end up in those circumstances because they didn't know, right? I mean, people can make their own decisions as long as they have the information. And I have clients who they don't want to leave anything for their kids. They want to spend it all. I earned it. My kids are fine. They went through college. They've got their degrees. They're good. And other people who want to, feel that they want to leave everything they can to their kids. And so it's understanding that in the conversations that we have with our clients. And again, back to that team approach, figuring out what the client's wants and needs are to make sure that we're advising them based on those wants and needs.
I have an interesting question, just for conversation, but, and I've looked at the Roth IRA over the years and I've said, hey, you know what, people are accumulating money in there. And we haven't seen a period of time where there's millions in the Roth yet.
Like $1 million Roth
because it took a while to catch up, and the amounts you can put in there, have been low historically for a long period of time. But now with conversions and with people putting in much, and you're seeing a lot of multimillionaires use it, in an effective tax strategy. My thought is that eventually the government's going to catch on, and they're going to start altering maybe the ways that you can use the Roth, who can add, what you can do. And I know they've talked a little bit about that recently with some of the things in Congress and legislation going through of removing some of the conversion strategies or from the 401k Roth being rolled over and stuff like that. What's your thought on just the general nature of the Roth?
Oh, I think it's a great vehicle. In fact, we're seeing more and more now on W-2s for people that are working that they're putting part of their contributions into a Roth plan now, not all into a
just traditional, right?
Yeah. As part of their company benefits that are available to them. So that's a way that people can put more into a Roth if they're using their company plan to do that, and if that's an available option. But I think they're a great vehicle, and I agree with you. There has been discussion in Congress about clamping down on, they're viewed as a tool for the wealthy to get benefit from, and Congress doesn't always want that to be the case because they're preventing tax dollars from being paid into the government. The more that's in the Roths, the less taxes that are going to be paid. Again, we've worked with clients on the conversions. I'm seeing that more now. There was a time, and again, I'm going to date myself here, it's probably 10 years ago, but there was a cap on what you could convert into a Roth. That's been lifted for quite some time now. So it wouldn't surprise me if we went back into a point where, maybe up until your age 59 and a half, you can't do conversions other than a certain dollar amount.
Certain amount, yeah.
Maybe once you reach retirement age, they would allow you to do something more.
Let's dissect it just so people know, because if you're listening and you're not a financial guru, you may not know what a conversion means. So remember, if you're working and you earn income and you're under the income cap, you can do a contribution from bank account, right?
Yes.
So if, let's say I'm retired now, I'm 62, I have $1 million in my IRA, right? It's with a group, Vanguard, whoever, doesn't matter. It's with a group. So at that point, if I'm not working, I say to someone, hey, we can do a Roth conversion. They're like, no, I can't. I'm not working. So let's really dissect that and help me understand it. Just so from the CPA side, What's the difference? And can I do it? So it's important that you look at it.
You absolutely can. And right now there's no caps on that. So
even if I'm not working and I'm over 59 and a half, I can still do a Roth.
correct.
Got
You can't contribute to it.
There we are.
But you can convert one to the other.
Got it.
And again, as long as you have the tax available to pay on the conversion, then
Sure.
And if you're over age 59 and a half, you can take a distribution and use some of that because you're going to pay tax on the whole distribution anyway.
So if I have $1 million in my IRA and I'm 62 years old and I convert 100,000 over to my Roth, a different registration, I can just withhold taxes on the flow of the money.
You can.
And 100,000 moves from point A to point B, and it shows up, and there's 80,000 at point B.
Correct.
But then at point B, how does it grow? All tax free.
Correct.
Got it. Okay.
So you could get that $20,000 tax back pretty quickly, depending on how the market is.
I kind of like to play it out, and not that I want to be too coy about it, but it's like sometimes people get those words confused, and I feel like it's important.
But
to
even
be educational.
even just that transaction creates a tax opportunity.
Right.
Because you don't have to withhold the money on the conversion. They can pay it on their other asset.
Absolutely.
So
Correct.
perhaps they have another asset that they're looking to divest of that there's a loss on, that they can take that, they can liquidate that asset, get the taxable loss for the year, and make all the money go into the Roth that they're converting over, which is even better than for them in retirement.
Absolutely.
So, you really have to look at all the nuances of that conversion.
So a really good plan. Let's play a real world now. The buckets of my income, my progressive income, I filled the first 3. I'm in the 22% bracket. I filled the next one a little bit. I can fill it a lot more, and I'm still in the 24% bracket. So in that scenario, if we do a Roth conversion for 200 grand, let's say, it keeps me in the 24% bracket. I could offset it with a loss from like a non-retirement vehicle and get money to go from my IRA to my Roth and end up keeping pretty much the dollars that I have.
Absolutely.
That'd be a phenomenal plan, right? But that would
Indeed
take
it would.
coordination
Yeah.
Yes.
between the CPA and
Well,
your
yes, it does.
advisor.
Well, and then the other thing to look out with that too is after 72 for the required minimum, the RMD has to come out first before the conversion can happen.
Right.
And a lot of times that clamps down on what you can convert. So really that retirement age to 72 is a really nice window to be able to do that.
I'm guessing, to say this out loud, this isn't for everybody. This is only one method, and there's a lot more than this. There's many other methods, but just to kind of put it out there.
Well, that's one of the reasons, a lot of times.
tool.
It's a tool
A lot
in the
of
toolbox.
a lot of the times for those people, we come in and recommend a LIRP, life insurance retirement plan.
Yep.
In the context that when they get to be 72, that RMD has someplace to go that's tax efficient.
Right.
And it's non-correlated. It's not going to, it has, something that's not going to act the same as perhaps the stock market, depending on the vehicle that we use.
We kind of talked about that in our pension option planning conversation, right?
Yeah, and diversification as well.
Sure.
You know what I mean? But that's important to understand is that window of ideal opportunity is very short, but that by moving it to 72, we just increased it by 2 years. So that's a phenomenal
That's a
rule
huge.
change.
That's a huge jump.
I mean, just those 2 extra years of being able to convert is just, can mean a lot over the life of those assets.
One thing there's no way to get back is time.
Time. That's an advisor's best friend. I always say that to people.
There's no way to get
And we have
back.
hints
Wait a
of
minute,
time
did
all
Iron
around.
Man say that? No amount of money can buy a second of time, right? We're big Marvel fans in here. Just FYI, we love talking all things Marvel for a minute by minute.
Well, one other topic I think that we should kind of just touch on before we close out the show is really how assets are treated in a trust versus on their own.
Sure.
Because a lot of people just think, oh, I'll move my money to the trust and I'll keep the investments the same and I'll just let them go. And then if we need to change anything to protect the asset from market risk or something, we'll just handle it when it's in the trust.
Right.
But that's not always the case, right?
No, it's not. In fact, keeping that asset mix the same could create significant tax issues inside the trust. So most of the trusts that we work with, the irrevocable trusts, they're designed largely with Medicaid planning in mind for long-term care planning. So the trust provides that the beneficiaries get the income for their lifetime, but capital gains are not considered income that's distributable because it's really corpus. So if you sell something and have a gain, or if you're in mutual funds and have capital gain distributions, those are part of the asset. They're not earnings from the asset. And trust tax rates, they're the same rates as what we have individual, But you get to the head of the class and the trust tax return rates very quickly. So we often find that clients are paying more tax if they don't design their portfolio, to be more income generating, where that passes out and is taxed at the beneficiary's tax rate versus capital gains that stay inside the trust and are taxed at the trust tax rates.
Again, like that, you said a lot right there. And as for a listener, like their head's probably swimming right now, right? So like, let's dissect it. I'm sorry, because I'm pretending I'm the listener right now. I want to be like, David, what the heck did you just say? Like,
Keep
dude,
it simple.
Wait a minute. So let's think of it like this. A trust is like another person sitting in the room, right?
Yes.
Like another person. They have an EIN number, an address, a phone number, and they're holding on to the asset for the purpose of what? Making sure that the person who originally had it doesn't lose it to Medicare or a nursing home, right? Something like that.
Medicaid, yeah.
Right? Whatever, Medicaid, sorry. But the truth is that this person that's holding the bucket, their tax efficiency is very poor because tax brackets for trusts are tough.
Yes.
They're difficult.
So like, just so the listeners can understand, to be in the top trust tax bracket, approximately how much do you need?
$12,000-$15,000 of income.
Of income.
Wow. So imagine if you were
Help me.
imagine
Okay,
if you
I'm
were
the trust.
working.
I'm the
imagine,
trust, right? Yeah.
Imagine if you were working at your job and if you made over 13,000 roughly, you're in the top tax bracket.
You're paying 40%.
Everybody's getting kicked out of office.
So the trust that holds the asset, David, if that trust generates $15,000 of income that stays in the trust, what happens? It gets whacked in taxes?
It does. So the trust ends up paying those taxes,
I
which
understand
deplete
now.
the assets.
So as an advisor on our advisor side, we have strategies
Tax
that
managed strategies.
try
tax
to
efficient.
manage some of those inefficiencies so that the portfolio can help decrease some of that tax inefficiency.
Yes.
Okay, good. I just want to make sure the listener understands because they're like, what the heck did you just say? That's a lot, So I try to keep it a little bit simple for everyone out there.
Well, excellent. Let's do a quick recap before we get to some minute by minute stuff. And just obviously we covered a lot of topics today, but I think the best recap that our listeners can take away is they really need to look at working with a CPA.
Oh yeah.
They need to have that in their mix. They need to have that person in their tool belt, so to speak, of professional advice and guidance. We covered a lot of topics that may have went over some of the listeners' heads, but in reality, it's all to benefit the client's financial situation. And the other thing really is to start looking at different planning concepts because there's it's not always just I don't need the money, I'm not going to take it. Having that concept down that it's okay to take money and pay taxes on it because I'm going to benefit myself in the future or my family, I think is another important recap point that people need to start thinking about. Because it's always been, I don't want to pay. Somebody's going to pay.
At some point.
And we might as well pay pennies on the dollar versus the full amount later. And if we can do that, that's important.
What you're saying is balance and moderation, right? I mean, again, it's the same thing for your diet. You can't eat 100 Snickers bars because you'll pass out and die, right? You have to moderate what you're putting into your body, just like your portfolio. You have to moderate that and make sure it's being overlooked correctly.
Yep. So, we appreciate your time today. Thank you so much for coming in. And our one session that we do is minute by minute. So I guess we'll start off by just asking you some general questions.
Yeah.
You got any favorite hobbies? I mean, you're over in Rensselaer with me, but any favorite hobbies that you like to do?
So I enjoy golf. I'm not a very good golfer, but I enjoy golf.
Same here.
I take a lot of swings. But I enjoy that. My kids are both out of college at this point, but my daughter, primarily my daughter was a high school and college athlete, so we've spent a lot of our free time following her and getting to know some of the families that she
What
played
sport
with.
does she play?
She played softball in college, Division II athlete.
Oh, wow.
And she just finished, she went back to Hudson Valley to get an associate's degree after her bachelor's degree from St. Anselm, and she played basketball.
Oh, wow, that's great. So basketball and
she
softball.
She got a season of basketball in. Hadn't touched the basketball in 4 years since she
When you're an
graduated from
athlete,
high
you're an
school,
athlete. When you're an athlete, you're an athlete, David. She must have got that from Dad, by the way.
No, and nor my wife. So I think there's a mailman somewhere out there.
Matt, by the way, is our hidden weapon when it comes to golf outings. He does our putting for us.
Oh my God!
If it's 30 feet away or 40 feet away, he's gold.
This year we'll be doing a fun golf outing, and hopefully you can come and join us. It's a lot of fun, but ultimately, yeah. just getting on the course and having fun. That's the most important thing. Yeah, for sure.
And I do have to plug my son too. My son and I spent time. He's an Eagle Scout, so I spent a lot of time in Boy
Always be
Scouts with
prepared.
him.
I
It
am
was
as well.
It was a phenomenal experience and great stuff that Scouts teach, and a lot of camping trips. All of them in the rain. I don't think we
Of
had
course
a
it
dry
rains on
camping
kids.
trip.
That's the
but
best time right there.
So-
Did you win the Pinewood Derby?
No,
I won every time.
no.
You know the trick? I know the trick. I could tell everyone a trick to the Pinewood Derby. You want me to release the trick?
Graphite is
No, it's not the graphite. When you build the car, you got to drive the nail through the body of the car so the weight distributes evenly across the car. Because you put all the weight on the front, then the wheels actually slow down. So if you put like a screw through the center of the car, the weight distributes evenly through all 4 axles, and you're going to get more downward flow. We won every year.
Had I only known that.
We won every year. A little bit of an engineer in me too, Mark.
now our listeners are going to expect to win, but if they're competing against each other, they're not.
But then there's a special little substitute you got to do. You got to do some extra stuff to the axles. But yeah, I was an Eagle Scout as well, so
Great.
phenomenal experience.
Dave, why don't you tell us where listeners can find
Yes.
your services? This is the best way to contact you.
Hey, so thank you very much for having me in today. This has been great. It's been a nice conversation. Our firm is located in Troy, 314 Hoosick Street in Troy. We're about 0.8 of a mile up the hill from the Hudson River. Pretty easy to get to. Phone 518-274-9081. We have a website where you could find information on the firm. It's scottstackrow.com. SCOTTSTACKROW.com. I have 2 partners, so you can call and ask for Dave or Allison, and one of us would be happy to help you out if we can.
So if you say the name Dave, you're going to be 2 out of 3. You can't.
2 out of
you can't really
3.
miss.
You've got a little over 10 staff there, right?
We have 10 staff, so 7 accountants and 3 admin folks, and the accountants produce 7/10 of the work, but the admin folks, even though there's only 3 of them, they have to get that 7/10 out the door. So they in some ways work twice as hard as we do.
Great, excellent.
So paper's always the hardest part.
And
right?
as always, you can find the Esley Group at 43 British American Boulevard in Latham. 800-222-3202 is our number. And you can also find us on yourtimeyourmoney.net, and that's net for your net worth. It'll bring you right to our homepage and have links to our other episodes as well as other educational information that you might choose. So thank you so much for joining us today. It was great, and we look forward to seeing you next time.
Thank you. I hope you have me back.
Thanks.
Your time, your money.